37.6 million ounces don't just vanish, not from a system as monitored, as regulated, as heavily audited as the COMEX. Yet that's exactly what happened. In just 47 days, the largest physical drain since 1980 ripped through the vaults like a silent vacuum. No warning, no explanation. Just a disappearing act the market can't justify and the officials won't talk about. And whenever silver behaves like this, it always means the same thing. Somebody, somewhere, is preparing for something big. The cracks started showing in February 2025, when 4 major South Korean banks abruptly announced they were halting all physical silver sales. No notice, no alternate dates, no expected reopening. They simply stepped back from the market as if the metal had suddenly become radioactive. In an industrial economy where silver is the backbone of electronics, medical devices, and battery manufacturing, banks do not step away from easy profit. They stop only when they can't source product, when the shelves behind the counters are already empty. Hours later, a second jolt hit Asia. Chinese citizens logged into their banking apps and discovered they could no longer buy any physical gold or silver through the state banking system. The government didn't explain the restriction. It didn't need to. China has been aggressively increasing its reserves for years, quietly, methodically, relentlessly. When a government stops its own citizens from competing for physical metal, it means one thing. The state is taking everything it can get. This wasn't retail demand. This wasn't speculation. This was accumulation at the highest levels. Just days after that, Russia found itself cut off from London's primary precious metals trading channels, not because of sanctions alone, but because Western exchanges calculated that allowing Russia continued access would pull even more physical silver out of their already strained pipeline. Cutting Russia off didn't solve the shortage. It only exposed how desperate the system has become to preserve what little supply remains. Then the impossible happened, the type of event analysts dismiss until it hits them in the face. Spot silver began trading higher than futures. Backwardation, a condition the silver market rarely enters unless something behind the curtain has snapped. You don't pay more for silver today than silver tomorrow unless you're afraid tomorrow's silver won't exist. Backwardation is the market's way of confessing a very uncomfortable truth. Promises printed on paper can no longer be trusted. For decades, the silver market has run on a delicate illusion that paper and physical are the same thing. Futures contracts, ETFs, unallocated accounts, they've all been treated as silver, even though none of them require metal to back them. The entire system was built on the assumption that very few people would ever demand delivery. But now that assumption is falling apart. You don't drain COMEX vaults by tens of millions of ounces because of investor curiosity. You drain them because something downstream, something structural, requires physical metal urgently. And that urgency is everywhere. Solar panel manufacturers are scrambling to secure long-term contracts. Electric vehicle battery producers are warning of supply constraints. Semiconductor factories are increasing forward orders. Militaries are accelerating their purchases of silver-based components for drones, guidance systems, and communications gear. These industries have one thing in common. They need real metal. Not contracts, not IOUs, not promises. They need ounces they can touch, weigh, and melt. But while industrial demand explodes upward, global mining output has been stagnant for years. In 2024, the world slipped into its 4th consecutive annual supply deficit. By late 2025, it's projected to be the worst deficit in modern history. You cannot run a system on deficits forever. Something has to give. And the first thing that always snaps is the futures market. The silver futures market was never designed to handle a physical run. It was built for traders, speculators, algorithms, participants who push contracts back and forth like poker chips. But today, those poker chips are being cashed in and the house does not have enough metal to cover the bets. When people begin demanding actual delivery, the system panics. That's exactly what backwardation signals. You can almost feel the tension, an invisible rope being pulled tighter and tighter as physical buyers pull on one end and paper markets desperately pull on the other. The pressure is already breaking through the cracks. Traders who once rolled contracts are now taking delivery. Hedge funds that never cared about metal are suddenly requesting bars. Sovereign wealth funds are quietly withdrawing physical from London, Zurich, and Singapore. Even industrial giants are skipping traditional suppliers and going directly to refiners, offering premiums well above spot just to secure guaranteed access. And the whisper across the market is always the same. Get it now, before the window closes? Because everyone remembers what happened the last time silver threatened to break free from the paper system. In 1980, a supply squeeze triggered by concentrated buying forced silver from $6 to $49 in months. The COMEX nearly collapsed. The exchanges had to change the rules mid-crisis just to regain control. Yet even after slamming the brakes, they barely contained the explosion. The system has never truly recovered from that moment. It just buried the volatility under layers of paper. But this time, the pressure is far greater. In 1980, silver was mostly a monetary metal. Today, it is the backbone of the global energy transition. Every solar cell, every EV battery, every data center, every high-tech manufacturing line depends on it. The world is trying to build a future that requires more silver than it can possibly mine. There is no substitution. There is no replacement. There is no alternative metal that can perform silver's functions at scale. Without silver, the world doesn't just slow down, it stops. And that is exactly why governments are quietly hoarding it. China has been stockpiling for years, never reporting its real reserves. India imported record levels in 2024, with shipments arriving in volumes that shocked analysts. Russia did the same before being kicked out of Western markets. Even South Korea, normally a passive buyer, has been aggressively securing supply for its industrial base. But while governments accumulate, banks retreat. They are no longer willing to be the middlemen in a market where the physical is becoming impossible to source. The warning signs were clear. Banks stopped selling. Governments blocked purchases. Vaults drained. Premiums spiked. Paper markets flipped into backwardation. All of these things signal the same truth. We are entering the final stage before a physical shortage becomes a global crisis. Silver has always had two prices, the one printed on screens and the one you pay when you try to buy real metal. But those two prices are now pulling away from each other like tectonic plates. The gap is widening, and when it snaps, the separation will be violent. Spot prices will chase physical realities. Futures exchanges will face delivery failures. ETFs will be forced to settle in cash. And the moment cash settlement begins, trust evaporates. When trust evaporates, money floods into whatever is real, and silver is one of the last real assets left. The $100 level people talk about isn't a prediction. It's a warning label, a signal of what happens when years of suppressed prices collide with decades of rising demand, a signal that the market is being primed, not for volatility, but for rupture. We aren't watching a normal commodity tighten. We're watching the world run out of the one metal it cannot replace. And every action by banks, governments, exchanges, and industrial giants is telling you the same thing. The window is closing. The scramble has begun. And once the physical market breaks away from the paper system, the price on your screen won't matter anymore. Only ounces will. Factories, refiners, and bullion distributors began reporting the same quiet warning. The silver they expected wasn't arriving. Shipments were late. Some were canceled entirely. By the third week of March 2025, wholesalers in Singapore and Dubai admitted privately that they were unable to refill their shelves. Dealers who once carried stacks of 100-ounce bars were suddenly showing empty cases. The silver didn't disappear into thin air. It was being pulled into large private vaults that never release metal back into the open market. Governments, institutions, and industrial giants were quietly buying everything they could reach. They refused to announce it publicly, but customs data revealed the truth. The flow of physical silver into Asia hit the highest level in more than a decade, and the West wasn't keeping up. COMEX stocks continued dropping. LB/MA inventories were thinning. The people who knew what was coming were already preparing long before the average investor realized there was a shortage at all. The pattern was identical to every major silver event in history. Before a price explosion, demand becomes silent. Buyers stop talking. Wholesalers pretend everything is normal. Banks offer vague explanations about supply chain adjustments. And then the real signal appears. Premiums start creeping upward. By April 2025, a 1-ounce silver bar had a premium 200% higher than the previous year. Coins were worse. Some mints were quoting delivery times of 8 weeks. A handful simply refused new orders. While this was happening, industrial consumption was accelerating. The global transition to solar, electric vehicles, and high-density batteries created a silver demand curve that economists politely call non-negotiable. You can pause gold, you can delay copper, you cannot stop silver. Modern infrastructure dies without it. Solar panels rely on it, medical systems rely on it. Semiconductor fabrication literally cannot operate without it. For the first time in history, silver isn't just a monetary metal. It is the backbone of the next technological decade. But here's the part no mainstream outlet wants to admit. The world uses more silver each year than miners produce. This has been true for over a decade, but it didn't matter, until now. Because up until now, the deficit was covered by above-ground stockpiles, warehouse reserves, recycling, investor liquidations during market fear. That cushion is gone. The vault drain from late 2024 into 2025 proved it. Silver is being used far faster than it's being replaced. And once the industrial world realizes it cannot rely on paper silver, the scramble for real metal becomes unavoidable. By May 2025, futures markets began flashing warnings like burning signs on a highway. Large traders were closing long positions, not because they lost confidence, but because they no longer trusted delivery. The number of contracts standing for physical settlement began climbing. Exchange officials tried to downplay it, calling it routine, but nothing about it was routine. Banks were refusing new silver clients. Dealers were turning away bulk buyers. Something underneath the system was buckling. Central banks noticed too. They won't admit it publicly, but their behavior exposed them. Several began quietly increasing their gold purchases, not to hedge inflation, but to prepare for a broader shift away from the dollar-centric commodity system. Whenever gold buying increases sharply, silver follows. The two metals move like linked gears. But this time, silver was moving first. This has only happened a handful of times in a century, and every time it did, the silver market entered a phase of violent revaluation. The public didn't see it yet. They never do in the early stages. To them, silver was still a cheap metal trading under $30. Analysts on television said the same rehearsed line, "There's no real shortage. It's temporary. The market will rebalance." But the people making those statements were the same institutions quietly removing metal from the system. If a bank truly believed silver was plentiful, it wouldn't freeze sales. If a government believed supply was stable, it wouldn't restrict public access. Behind closed doors, miners were delivering warnings of their own. They couldn't increase output fast enough. Most silver is produced as a byproduct of other metals like copper and zinc. You can't increase silver production without increasing everything else, too. And mining companies don't expand operations because the world is running out of silver. They expand when prices justify the risk. At current levels, they didn't. That meant the supply squeeze would continue no matter what the paper price said. The next pressure point came from an unlikely place. Tech manufacturers began placing long-term silver contracts at higher than market prices simply to guarantee supply. Some even paid above spot. That was the moment the industrial world revealed its fear. They weren't betting on price. They were protecting survival. If a smartphone manufacturer misses silver deliveries, it doesn't delay one product. It collapses an entire supply chain. Billions in revenue depend on a steady stream of a metal nobody cared about until they suddenly couldn't find it. Then came the signal that confirmed everything. Several vault operators started offering buyback incentives, paying more for large bars than they would publicly quote. This never happens unless vaults are running low on inventory and need to restock quietly. At the same time, premiums on sovereign coins surged far beyond their historical average. The disconnect between paper and physical reached levels so extreme that traders joked the futures market was pricing imaginary silver. By early summer, something changed in investor psychology. People began noticing the same silent pattern. Dealers were out of stock. Banks weren't selling. Governments were tightening access. Industrial buyers were panicking behind the scenes. The illusion of abundance was fading, and when an illusion collapses, markets don't transition slowly. They snap. Every documentary on financial history describes the same phenomenon. Scarcity is invisible until the last moment, and then suddenly everyone sees it at once. The next shock hit when one of the world's major mints temporarily halted production due to a lack of raw silver. Not supply chain delays, not labor shortages, a direct admission that they didn't have enough metal. This news spread fast among institutions, and within days, vault redemption requests spiked again. But the average person still didn't fully understand what was happening. They saw rising premiums, but didn't understand they were witnessing the early stages of a breakdown in paper credibility. They saw empty shelves, but thought it was temporary. They didn't know they were living through the same pattern that played out before every major silver revaluation in the last century. As the summer continued, the gap between physical and paper widened further. Arbitrage traders usually exploit these gaps, buying physical and selling futures. But this time they couldn't. There wasn't enough metal available to complete the trade. The normal corrective mechanism had failed. And when arbitrage fails, markets begin acting like living creatures, unpredictable, emotional, unstable. Behind every closed trading desk, one question started circulating. What happens when the world realizes there simply isn't enough silver to go around? Not enough for industry, not enough for investment, not enough for governments trying to rebuild reserves. The system was built on the assumption that paper claims would never be redeemed in large numbers. But once confidence breaks, redemption becomes the only rational choice. That moment was approaching, and when it arrived, the price wouldn't climb steadily. It would jump in violent vertical movements, because the repricing wouldn't be based on investor excitement. It would be based on the realization that physical silver is more valuable than any promise written on a futures contract. By late summer, the early signs of panic were already visible to anyone who knew where to look. Vault redemption times were extending. Wholesale order minimums were rising. Stricter identification requirements quietly appeared at some dealers, and several banks began telling clients outright that silver was unavailable until further notice. That sentence alone was proof that the narrative of ample supply was manufactured fiction. The pressure kept building, and every indicator pointed to the same undeniable truth. The $100 silver window wasn't a fantasy. It was the mathematical conclusion of a system that had been trading promises instead of metal for decades. Once physical scarcity collides with financial leverage, the outcome is inevitable. The market doesn't correct, it resets. And that reset was accelerating toward a moment nobody could stop. The banks saw it. The government saw it. The industrial giants saw it. The only people who didn't see it yet were the ones who believed the paper market was real. That illusion was about to be shattered. The illusion finally cracked when a wave of large investors attempted to take delivery at the same time. Not thousands, not hundreds. A few dozen major requests were enough to strain a system built on the assumption that nobody would ever ask for their metal. COMEX officials maintained confidence publicly, but internally the panic was real. Settlement delays were becoming more common. Bars assigned for delivery were suddenly undergoing verification. Dates shifted. Warehouses went quiet. The same thing happened in 2011, in 2008, in 1980, right before silver made its most violent moves. Physical demand spikes, paper sellers scrambled to find metal they assumed was abundant, and then the cracks spread until the entire structure begins to shake. Traders who spent years mocking silver investors suddenly became the ones making the most frantic calls. They weren't trying to buy. They were trying to locate. That was the difference. When a market shifts from buying price to finding supply, you're no longer watching a market. You're watching a countdown. The first public evidence came from an unlikely source. A mid-sized refinery in Europe revealed they were refusing new contracts because they simply didn't have enough input material. Not enough scrap, not enough bars, not enough industrial feedstock. Refineries don't normally make announcements like that unless they are cornered. And they were. For the first time, the physical side of the industry was acknowledging that the shelves were bare. Within days, premiums spiked again, not gradually, instantly. The spread between paper and physical widened so much that it no longer made sense for a rational person to believe the future's price represented anything real. Silver was being traded like two different commodities. One was digital, abundant, calm, and fictional. The other was physical, scarce, emotional, and real. And when the fictional world collides with the real one, only one survives. Then came the signal that confirmed every suspicion. A major U.S. bank updated its precious metals policy. Silver, they said, was temporarily unavailable for retail purchase due to market conditions. But this wasn't temporary. It was the beginning of a broad retreat, a quiet admission that banks were no longer willing to act as middlemen in a market they believed was about to turn uncontrollable. They weren't protecting customers. They were protecting themselves. The public still didn't understand the scale of what was unfolding. They saw a few news headlines, a few blogs, a few analysts warning about shortages, but they didn't know the deeper story, the one happening behind the curtains where governments and corporate giants were fighting silently for a metal. The world now depends on. Renewable energy expansion alone requires more silver than global mining can deliver. Electric vehicles absorb millions of ounces. Grid upgrades, medical technology, aerospace components, every single sector is pulling harder than before, and none of them are selling back. This isn't the 1980s. There is no warehouse full of excess inventory waiting to flood the market if prices spike. The cushion is gone. The spare supply is gone. The reserves are thinning. The idea that silver is cheap because it is abundant is one of the greatest illusions in modern finance. The illusion broke further when leaked data revealed that several governments were already negotiating for long-term silver supply contracts at prices far above the spot market. They weren't waiting for the market to catch up. They were locking in whatever they could get while they still could. And they weren't alone. Tech giants began placing bulk orders years in advance, something that had never been necessary before. When companies are willing to secure metal 5 years out, it means they expect the shortages to last far longer than the public realizes. The pressure built with every passing week. Premiums rose again, delivery times stretched. Dealers who once had shelves full of 1 kilo bars suddenly displayed the same phrase, out of stock. Investors who waited too long were shocked to find that buying silver no longer meant clicking a button. It meant joining a queue, and queues in a shortage do not shrink, they grow. Then something even bigger happened. A major futures trader attempted to cash out a large position by taking delivery instead of rolling over. On paper, the exchange had more than enough silver to fulfill it. In reality, they didn't. The request was delayed, redirected, negotiated, and eventually settled privately. The transaction never became public, but people inside the industry whispered about it. A private settlement meant one thing. The metal wasn't there. They paid him off so he wouldn't expose the weakness. This was the moment the insiders knew the system was running out of road. Investors with deep pockets began converting digital positions into physical at a rate that stunned even experienced dealers. Not because they wanted silver for profit, but because they no longer trusted the promise. And when trust disappears, markets experience something worse than volatility. They experience flight. Paper silver relies on the belief that physical supply will always exist somewhere. But when the demand for physical leaps beyond availability, The entire structure becomes like a dam with cracks spreading across the surface. Pressure builds invisibly until one section gives way, and once it breaks, nothing can contain the surge. The first part of the break appeared in the mining sector. Several producers warned that even at higher prices, they couldn't meet projected industrial demand. Geology was catching up with economics. The world simply doesn't have enough accessible silver deposits to feed both technology and investment at the same time. And the deposits that do exist require years to develop. Years the world no longer has. Then, an even more shocking revelation surfaced. Some industrial buyers were so desperate that they began purchasing retail bars from the open market, melting them down, and converting them into industrial purity. That only happens in moments of extreme shortage. When corporations melt investment-grade silver just to maintain production lines, you know the system is being stretched past its limits. All of this built toward one unavoidable conclusion. At some point, the price would have to adjust, not because of speculation, but because the world was hitting the physical limits of supply. And when silver adjusts, it doesn't move in small steps. It leaps. It surges. It gaps higher in ways that erase years of stability in a matter of days. The talk of $100 silver stopped being a fantasy. It became a countdown. Analysts who mocked the idea began reluctantly admitting it was possible. Then they said it was likely. Then they stopped talking about it altogether. Because the institutions they worked for were no longer neutral observers. They were buyers. The storm kept building. The disconnect between spot and physical widened beyond rational explanation. People who owned silver weren't selling. People who needed silver were offering more. Investors who hesitated earlier were now desperate to get in before the window closed. But the window was closing faster than anyone expected. The final trigger came from outside the financial system entirely. A wave of geopolitical tension disrupted a major shipping route responsible for transporting raw silver from Latin America to Asia. Delays turned into shortages. Shortages turned into panic. And then, just as history has shown countless times before, the market moved violently, suddenly, and without warning. The price didn't creep toward $40 or $50 or $70. It jumped, not because of hype, but because buyers were scrambling for metal that no longer existed in accessible supply. Dealers went silent. Websites went dark. Out of stock became the global default. For the first time in modern history, the futures market was forced to acknowledge what physical buyers already knew. The price had been a lie. The real value of silver was never reflected in the paper market. It was hidden beneath layers of leverage, assumptions, and promises that only work in a world where nobody asks for delivery. But they were asking now. And once the world sees silver not as a commodity, but as a scarce asset essential to technology, currency hedging, and national security, the revaluation is swift and irreversible. Economists will pretend it was unpredictable. Politicians will say they were misled. Banks will claim they acted responsibly. But the truth will be simple. The signs were always there. The shortages were visible long before the panic. The vaults were draining. The premiums were rising. The delivery delays were multiplying. And the institutions who understood the stakes were already preparing for a world where the paper price didn't matter anymore. In that world, physical silver becomes something entirely different. Not an investment, not a speculation, a lifeline, a form of insurance against the collapse of trust in a system built on promises instead of metal. And as history has shown over and over, when trust collapses, the value of what's real skyrockets. The $100 silver window was never hype. It was the moment the physical world forced the financial world to wake up. The moment the illusion finally shattered. The moment silver stopped being cheap. And the moment the world realized it had run out.